Hello everyone, good afternoon and welcome to today's home games. It's lovely to see quite a lot of you here actually. So yeah, I think today's news may have had something to do with that. So thanks very much to everyone for joining us. I'll do a little bit of housekeeping as per usual, and then we'll go into the chat because obviously there's loads to discuss, and we had loads to discuss even before the Aviva succession news that broke conveniently this morning. So I think people know how this works now. You've got a chat down the side, which is already busy and active, which is great. We've also got the ask a question button down the bottom if you want to get my attention away from the main sort of various threads of conversation, because it can get quite busy down the side there. But we do encourage all questions, comments, queries down the side or via that ask a question button. We've got a really great panel here today, kind of with very different and representative views from across the market. So it'd be interesting to kind of challenge them and gently grill them as we go through the next sort of 45 minutes or so. Yeah, please get involved. I'll kind of do my best to moderate as we go through. But I think without further ado, we'll kick off then. So I'm assuming that everybody on this call has kind of seen the news this morning, which kind of made me furiously rewrite my questions for this session today. So it is a big deal, the Aviva and succession announcement, and it is a big number as well. So it'd be good to kind of get each of your takes on it. And I probably should, it's a bit remiss of me actually, I probably should introduce you all for the people who don't know who you are. So we have, going around my screen, we have John Baxter, who is the CEO of True Wealth. We have Rob Stevenson from Kingmakers. We have Adam Smith from Fairstone. And we have Kevin Ferriby from Informed Financial Planning, beaming live to us from Portugal, which is lovely. So the Aviva succession question, I think I'll direct to you, Rob, first. So what was your take kind of as you kind of read some of the headlines this morning, and what you make of how that all fits together, really?
It kind of made a lot of sense to me, really. You know, Aviva have been sort of quite quiet. I think I'm gonna say I wrote an article a couple of months ago about the idea that consolidators will eventually become, you know, modern product providers. You know, when I was a kid, you know, back in the day in the sort of late 80s, showing my age now totally, we were kind of I joined MPI, and MPI did everything. And nobody batted an eyelid to that, you know, and then the advice market, you know, sort of fluctuated a bit like waves coming in and out in terms of who had what was called distribution, right, at that point. And that we're going full circle, I think, with that, you know. So, and there are a lot of opportunities. Obviously, the advice market's a really attractive place to be. So it made a lot of sense. I think when you have corporate advisors that are trying to, you know, go out and do a sort of proper sale process, they'll have gone to lots of different potential suitors. So lots of people will have looked at the business. And Aviva is a business that's very stable, has probably low cost of capital, equity risk premiums under control. So for them, they can probably pay a margin for, you know, they can pay a decent amount of money to come back into the space. So it made a lot of sense. It did make me pause and hat tip Simon. So, you know, in terms
Simon
of
Chamberlain, yeah.
He was the one and only consolidator, who's the original guy, really, in many respects. So, yeah, I expect he's kind of smiling from wherever he is. But,
yeah, you did a nice tribute to him earlier on Twitter. That was nice to see. Yeah.
But, interesting.
Yeah, and John, what do you make of it? Because it's that point that Rob made there about kind of coming full circle and provider-owned distribution. It's something that we've kind of been talking about a fair bit at the LANCAT, and especially at our kind of recent conference about a month ago, we were talking about this idea of this is where we started in the 90s and 2000s, was big provider-owned in-house advice arms and stuff. Then RDR and financial planning profession. And then now here we are again, all the big boys buying up advice. I mean, what do you make of that? And I suppose the succession deal in particular?
Yeah, I think as Rob says, to a certain extent, there's an inevitability about it. My thoughts on the particular deal, I think there's some really good people at Succession. I think they bought some really good businesses. I don't know the metrics of the deal or the mechanics of how they would bought. I just hope the people that sold their businesses, that have contributed to the building of that value, are participating in the sizable chunk that Aviva are paying for it. The inevitability, though, for me, the issue there is, I mean, even going back to, you mentioned the retail distribution review, almost that language really frustrates me. So I've been an advisor, 25 plus years. I don't see myself in distribution, and I see myself in advice. I think it's natural that product manufacturers, because of, as Rob says, the low cost of capital, are going to be able to pay extreme valuations at the moment. They're going to have to protect their distribution. I'd like to see the emergence of the continued emergence, actually, of the advice sector that designs its own manufacturing capability to act in the best interest of its clients, rather than being seen as a distribution outlet for somebody else's products.
And I suppose we are starting to see that with there are some advice firms of scale that are looking to kind of build a bespoke financial planning practice, but just scale it up and be national and all of that kind of thing, and start it from that financial planning piece rather than
and I think
that's product piece.
I think that's where the real opportunity lies. I think scale is essential. Access to capital to deliver that scale is essential. But I've always been part of planner-led businesses. I always want to be part of planner-led businesses. And so whilst I congratulate everybody involved with Succession for what they've achieved, I can't see that being a route that we would ever want to go down.
Okay. I'll come to you next, Adam, and then you, Kevin. What do you think, Adam, in terms of the news and the numbers, and is that a deal that you anticipate being in Fairstone's future? What do you make of it?
So I'll leave the crystal ball out of it, but I think from an advice sector specifically, and probably Fairstone more specifically, I think it's great news. To lock in that sort of multiple that's shown substantial sort of uplift over the last 3 or 4 years is great. I think on a similar metric, on a similar basis, it would value Fairstone sort of something around 700 million, which is fantastic news when you're part of the business and you can see that reflection of the value. But I think probably John hit the nail on the head that this isn't a distribution play, it's a financial advice play. And we've seen that across the spectrum of DFMs coming into financial planning, of traditional providers of products coming into financial planning. And I think John was absolutely spot on that the key bit that I hope is different this time around is it becomes a financial planning led proposition rather than a product provider led proposition. And I think if that stays true, and I read Mark's comments earlier, and I think he absolutely summed it up in saying that as long as the client stays at the heart of it rather than the profit margin stays at the heart of it, then I think it'll be a good thing for the industry.
Yeah, and I guess it can be quite hard to square that, because I think we'll probably spend a bit of time talking about consumer and client outcomes a little bit later on. But I guess the expectation and the skepticism around big advice businesses being bought up is that everybody gets churned into one centralized investment proposition, and it's not good client outcomes. So and obviously people are buying up these businesses for a certain reason, aren't they? So do you think the two can kind of coexist, where you have profitable, scalable, everybody's absolutely still getting their piece of the pie, but also the client is being looked after?
Yeah, and I think that's the big change in that we're in a more transparent industry, we're in a more professional industry, and that has to be at the centre of it. It can't just be cheap talk, it has to be meaningful action. Centralised investment propositions and more focused solution usage aren't the realm of big, large-scale financial advice businesses or provider-owned financial advice businesses. Just about every financial advice business has got probably a more concentrated product set than it had 5 or 6 years ago. And that just reflects that there are scale benefits that normally relate to the client. I mean, the example we normally quote is that we take an open architecture position across platforms. So we're agnostic to execution venue. We think there's some variety in there that's positive. But rather than taking that value ourselves, we relay that to the client. So the annualized saving across Fairstone clients from the scale benefit we negotiate on their behalf is 5.3 million quid. you can't get that in a small business. You can only get that when you get scale. And I think what we're seeing is the natural play out of probably where an SJP was 5-10 years ago, in that let's start to take that scale benefit and bring it into the advisory space rather than in the product manufacturer space. I think the difference with most modern financial planning-led businesses is that benefit is moving to the client rather than moving to a provider bottom line.
Okay.
And I think to your point, Natalie, just on the detriment side, I actually think that a lot of the product providers will be a safe pair of hands, because they do have that scale and they do tend to do things right simply because they've got shareholders and other people looking at them because they're bigger. Mm-hmm. It just is a different model to the one I hope that Adam and I would maybe see coming to bear in the future.
Okay, thank you. And Kevin, I wanted to bring you in here because part of the reason I was asking you to be a panelist and you kindly said yes was that you wrote an article for Illuminate back in November, I think it was, and it was all around, I think the headline was something like doing the right thing when it comes to exiting your business. And I think you had your own qualms and concerns about, the approaches that you were getting from consolidators, and you were kind of weighing up your options in terms of starting to transition away from the business. So I wondered maybe if you could kind of talk us through a little bit the approaches you were getting, maybe why they didn't sit right with you, and briefly where you kind of ultimately ended up.
Okay. Well, I suppose, as always, it depends what you're trying to achieve, doesn't it? We have these conversations with our clients all the time. What are your objectives? And for me, it wasn't just about the money. It was partly about the money, of course. I've spent a lifetime building up value and I want comfortable retirement for me and those around me. But it wasn't just about the money. And obviously, there are some very attractive deals out there from consolidators or profit aggregators or whatever any of these organizations want to call themselves. And obviously, these deals suit many people, but not me. It was, for me, a massive thing was that I wanted to look after the people that had looked after me over the years, namely our staff and our clients and our introducers. And we're, I think, quite well respected. Well, I know we are quite well respected in our community by clients and the professional community. And I didn't want to destroy our identity and culture that we'd built over a long time. I didn't want to put people's jobs at risk. I didn't want our lovely offices in the shadows of the Humber Bridge overlooking the Humber Estuary to be closed down. I didn't want to be at risk of having to shoehorn clients into an investment proposition to get a bigger payout or whatever, worried about fee levels, worried about service propositions and all this kind of thing. And you've got to recognize if somebody writes you a big check for your business, it's their business. So, they're in control. And a lot of those concerns had been addressed by people I'd spoken to. And I spoke to some really nice people, and not just nice people, very professional. And I'm sure they mean what they say when they say none of those things would have to happen. But I think today's news addresses a massive concern for me is, who's going to be calling the shots tomorrow? And the world could look very different for you in a year or two's time. And I just, I mean, I said it yesterday when we all got together. For me, I wanted to be able to look at myself in the mirror in the morning and know that I'd done the right thing, which was the headline of that article, as you said, Natalie.
Yeah, and I suppose some of the arguments that Adam has advanced here about kind of efficiencies of scale and all of that kind of thing, that presumably those arguments were made to you. I mean, what did you think?
Yeah, there were, but I, from what I saw, our clients are getting as good a deal as they would from elsewhere. I didn't see it as an issue. And again, with the clients we deal with, price isn't everything anyway.
And do you worry about this kind of idea of providers coming in or private equity coming in and taking us back potentially 20 years of progress that's been made in the sector?
We'll see, won't we? But providers in particular haven't got a great history, have they, of doing the right thing for the client long term. So we'll see. I mean, I hope so, obviously, for the sake of the clients. And I really hope this deal works for the people at Succession and their clients, but we'll see. I'm very much sitting on the fence on that one.
Okay. Very tactfully put. Okay, so I wanted to kind of take the conversation out broader now, and I will come to you, Rob. So thank you for putting your hand up very politely. And you can kind of come back on any of that. But I kind of wanted to talk to you as someone who is kind of representing, I guess, often both sides of these deals. I mean, I think you do represent buyers and sellers. It'd be kind of good to understand who you're kind of representing most at the moment, and I guess the issues that they're looking for your support with, and whether they've changed, I guess.
Yeah, I suppose that there's a couple of things just to pick up on from those earlier comments. Aviva's deal is all cash. It's cash on their balance sheet, so it makes absolute sense to spend that. So we shouldn't get confused about that and private equity, because it's just cash. They're just a big business spending money, right? So it makes sense. They need to deploy the capital. If it wasn't Succession, it'd be something else. It may well be more. Who knows? And of course, we're all for trends in this space. So again, who knows? What's going to happen now with other providers doing that. I think one of the things really important. Most of the firms that we deal with, they come to us because they don't know whether to stick or twist, right? And because we're consultancy and corporate finance, if they want to go quickly, then we can help them in a sale, and we represent the seller and charge our fees to the seller, and we do a competitive sale process for that. If they want to go over a longer period of time, that's like everyone's got a 3-year exit plan, right? It drives me insane, so 3 years, and that 3 years is rolling. It's always been 3 years forever, and little action is taken. But 3 to 10 years, those are people we work with long term, put strategy in place, help them to grow management resources projects. So sometimes in that work will be on the buyer's side, but what we tend to try to do is equip the buyer, because often the buyer is inexperienced by their own admission in terms of M&A, and that's where a much larger enterprise business is going to have a huge advantage, because they've got resources, they've got capital, they've got resources, they can do deals, they're doing them every day, they've separate integration teams, and you do see that in we do transactions with firms that people might regard as consolidators. Of course we do. And some of them are great, and they get deals done, often multiples at multiple different times. I think for a lot of firms that come to us, they recognize that they're either going to sell internally, either through an MBO or advisor buyout or a trust or whatever, or they're going to sell externally. And if they're selling externally, that's either going to be to a smaller firm that are using debt to try to do that, and they're going to do 1 or 2 of those as part of their own growth plan, or it's a bigger firm that are using a mixture of private equity and debt, because pretty much all private equity has more debt pushed into it in order to reduce the returns, which again, it kind of makes sense. I think for me, what I've seen in the last 10 years is a lot of changes in I guess the kind of like the principal agent conundrum, which is a conundrum about incentives. And when you have private equity come into a firm, they may not own proportionally a lot of the business, but they'll have a lot of control. So often the founder becomes the agent and the investor becomes the principal. Mm-hmm. And then it's about trying to align those incentives going forward. So the people on the ground who you might meet that are kind of representing the firm are remunerated in a very different way and often have very small amounts of equity. I've sat in one of those seats before and I had, bips, right? So, and you can get ESOPs and you can earn more money in those businesses and everything else, but there's a slightly different point of view perspective, I guess, when you're doing that kind of thing. Your incentive changes. So I think that whilst you can look at this and say, I don't want my clients, to have a change of fees or a change of relationship or a change of proposition or any of those things. If you look at your own track record last 3-5 years, loads of things will have changed. And the only constant is change. So things are going to change into the future. I think you have to look at like the resource ratios of businesses to try to unpack what kind of advice they're really giving. I think, everyone's a financial planner, but there's a huge amount of difference in the interpretation and actual delivery of the proposition. And it's different for everybody. There's lots of firms out there that will be absolutely fine selling to a consolidator. It's about finding the right fit for them. There are other businesses that are a bit more unique, and they're not going to be fine in there. And it's really sort of down to people like me, I think, to a certain extent, to try and help expose that. Not to say that one business is bad and another one's good, but it's just trying to find a bit of order and get people in the right spots.
Okay, thank you. I'll just stay with the Aviva succession thing, and then I'll try and move it on. But Rob Reed, hi Rob, he was sort of making the point here about there being a contrast between Aviva's legacy book and the typical clients of succession. And Adam and John, I kind of wanted to put this to you, but a bit wider, I suppose, in terms of this is the tricky part of consolidation, isn't it? Is that you're bringing together often, I mean, assuming you do have that cultural fit there, you're still bringing together very disparate and can be quite different businesses. So how do you kind of, I guess, address that and make sure that it is still one business at the end of it?
Yeah, I think just a quick bit on terminology, because Kevin quite rightly used the proper term, which is profit aggregator, rather than the consolidator. It's nice to know that people are sort of picking up, because they're two fundamentally different business models. And I think if an advisory firm is looking to transact, then that's the fundamental question they should ask, is what's the play here? Because I think that helps to answer some of those concerns around, where the business then goes, because an asset consolidator won't be as attractive, will be more attractive to a product provider who is thinking about asset consolidation than someone that wants to provide financial planning services to the back book, as is the indicated case with Aviva. I think it's great because if you look at those back books, they tend to be in legacy poor value products, not exclusively, but if you look at the overall cost, if you just take platform costs as an indicator, 5-10 years ago, platform costs on average for a sort of mid-level client are going to be 35-40 bits. You're now looking at sub 25 for even relatively small clients, and that's competition driving that down. With opaque old style products, you haven't got that competition. Whereas in a financial planning situation, that hopefully those clients will then get introduced by the link between Aviva and Succession, they're going to go through that journey to actually say, look, is this product still suitable? Is it appropriate for you? But more importantly, does it represent value? And that value bit is the new piece that I think comes in. So I think that's the general point on Succession. On the more sort of specific point around when a seller looks at that, then yeah, absolutely, it's about alignment of interest. So one of the things that we're always at pains to point out to all the people we talk to, and we don't tend to talk to people who are thinking about selling instantly because of our downstream model, is it's about aligning interests. And they won't always align. And if they don't, that's great. There are other options. But I think when you're looking at any transaction, be it small or be it big, like the Succession of Aviva, it's about that alignment of interests and understanding who gets what and how you can influence that to go through the deal. And particularly, I think one of the bits that might not be in the case of Succession, but is in the case of most of the transactions that we see at the smaller end, is that who gets that future value. Because one of the bits that you're really looking at improving by transacting into a bigger firm is getting the scale benefit to then free your time up to advise more clients or to do something different or to go to Portugal in Kevin's case. But then you've got someone picking up that remit who then can't see a client because they've got to deal with the conduct risk, they've got to deal with the other things. I think it's just thinking, what do you want to do in your business? What do you want to do? What do you enjoy doing in your business? And then how does that align to the interests of the people that you might be transacting with?
Yeah, no, that's right. And John, what do you think? Because we've kind of spoken before about kind of what's happening in the market, and you've had some good turns of phrase around fish and chips approaches, where people are fished at one thing and then you chip away at the offer and that's it, and the kind of bubble that we're in just now, and at the same time, as Kevin mentioned, people's heads are very likely to get turned by the numbers that are kind of being talked about. So what's kind of your take on how owner managers should approach this in terms of the pathway to exit? Because obviously a deal like Aviva Succession will have taken a long time to kind of come to fruition, and for a smaller firm it might be even longer. I mean, what do you think?
Yeah, sure. So I think there's no doubt we're in a valuation bubble. I think it's a great time to be thinking about selling a business. I think the other aspect of that, of anybody thinking about exiting their business, is it's likely that the taxation system is going to rise in the coming years. So I can see why lots and lots of firms and owner managers should be considering this right now, particularly the smaller businesses. I would encourage them, as Kevin did, be deliberate about it. Too many businesses are sold through what we call one of the 4 Ds, some sort, death, depression, debt, divorce. They're done through necessity. And most advice businesses, particularly the smaller advice businesses, spend their whole career planning their clients' futures. I think it's really time for firms and principals of firms to plan their own future. In terms of Aviva and Succession, Aviva have got lots of smart people there. They'll have a strategy for this. Well, typically when firms are of that size or deals of this size are done, it could be that it's a strategic play to understand distribution a bit better. It's unlikely to be a synergistic play. I can't see how much costs they're going to drive out the business. It could be, as Rob says, it could be a profit play. It could be a return on capital. It could be kept as a bit of a standalone business. I think there is a symbiotic relationship between them. I hope it'll be a good outcome for both. And I think there are enough other alternatives for the advisors or clients that want something different to what Aviva Succession provide.
Mm-hmm. Okay, thank you. So Innes has brought in the consumer duty rules, so that seems like a nice time to kind of turn the conversation to that. So there has been kind of some suggestion that we've got these new consumer duty sort of proposed rules that are set to come in, and the emphasis is very much on I guess the theme of our recent conference, which is nice, but the kind of the who benefits and where are the kind of consumer and client outcomes in everything people do. So I think probably I'll direct this to Rob and to Kevin, but where do you think that whole kind of new regulation coming down the track kind of plays into the consolidation model as it stands today? Because I guess, as I said at the start, there is this kind of expectation that, client banks rather than people get bought up, assets get bought up, they get shunted into something, and therefore people are worse off. And could the consumer duty kind of force a rethink of some of those models or not? Rob, you go first.
I'm never going to work in a regulated business ever again. I can tell, having said what I'm about to say, but life's short.
Okay.
Basically, it's just a bunch of form filling. Okay, very few businesses actually set out to shaft clients. It's rare. Mistakes are made sometimes. Some products are more expensive than others. Some fund performance isn't great. The consumer duty just looks like an old idea just being dusted off again, because they don't want to get into price regulation. Ultimately, there are some very, very expensive propositions out there, and you'll go to dinner parties. Do you remember them? Did we used to go to those things? But if you were able to go to a dinner party or a restaurant or whatever, you'd have someone fiercely, vehemently defending somebody that you might think is the devil. A business, a brand that you don't like. I'm not going to say the name, but I think we're all probably aware. But they exist. They're a very profitable business. They're highly liquid. They, ironically, some of those businesses are FTSE listed. Their cost of capital is low. They're some of the biggest payers. So I think the consumer duty won't have as big an impact as the change of control process tightening had. The change of control process tightening was something where they were saying, look, 2017, 2018, they did a review of some consolidators and said, look, what we're seeing here is there's a bit of confirmation bias. There's a lot of product getting moved around. Now, the clients are not saying, well, I don't like this. I don't think it's correct. Advice is very subjective. It's very well written up. But ultimately, there's a fair amount of churning goes on in a highly vertically integrated business. Now, there's always advice opportunities. And I think what the regulator was saying was we don't want that to be driving deals. So as a consequence, they say, well, we want to look at the deal paperwork and you need to append that to the change of control. Now, unfortunately, they implemented that in the middle of the pandemic and there was a lack of resource. So it slowed all these deals down. We're all sitting there waiting for change of control. But they are looking at the right things now. So what that, I think, drives is, if we talk about profit aggregators, right, that we're talking about synergies. In all M&A, what you're essentially saying is this business produces a certain amount of money and I want to sell it, therefore I want to capture some of that future money. That's all it is. So if it's profit, I want to double that, triple it, 5, 6, 7, 10, 20, whatever the multiple is, based on the trajectory of that company, the market, and so on and so forth, strength of the business. So ultimately, you know, if you're doing that, then it kind of, it makes sense to try to maximize that, but at the same time, the buyer is looking at that and saying, well, I don't just want to buy that existing profit margin. I mean, you can, but it's not sexy. So if you're buying that profit margin and you're thinking it's going to go up and to the right, that makes a lot more sense, because you get payback faster, you earn more money, you know, shareholder value, particularly if you've got a professional investor. Telling them that you took less is probably not, you know, overall a good long-term play. So ultimately, you've got hard and soft synergies. Soft synergies are revenue increases. So we've been there and done that. Vertical integration is all soft synergies. Now we're moving into hard synergies. And I think a lot of that was driven by the regulator changing the change of control process. Hard synergies are knocking out expenses. And don't get me wrong, I'm not being critical of Fairstone here. There are expenses that you can quite justifiably knock out. I've been into very few firms where there isn't waste. There's loads of waste. We all know there is. Technology's all over the show. And, you know,
and just on that, there's a really obvious one that I think is probably worth mentioning, just very quickly, is PI costs. So one of the things I think will become increasingly important, not just is that you've got PI cover, but the quality of that cover. And when you've got a bigger firm that can prove it, that can hold that track record, that is an absolutely massive synergy that probably shouldn't be underestimated as people look forward. Sorry, Rob.
No, and it's going to keep pinching. And so you see these things, and again, you know, some of these cost synergies are very difficult at scale. I think part of the problem comes when you hear horror stories then of, well, we sold the company to these guys and everyone was made redundant. Now, if you're going to just make everyone redundant, then why did you buy the firm in the first place? You're clearly not really seeing a lot of value there. So I think that there's a middle ground. But ultimately, consumer duty, it's something that everyone's going to have to pay attention to. So my comments are much more driven towards, is it going to change things for consolidators? I'm not so sure. Is it going to change things for everybody? Well, yeah, of course, everyone's got to comply. But still, the client needs more education, I think.
Okay, thank you.
I think just on that, Rob, so my issue with it is it's about driving a change in culture, or at least a lot of the documentation around it seems to suggest that. And, you know, having read the section about the reasons they're doing it, the harm it's causing, there's not a lot of those sections that would apply to a typical advice business. And once again, one of the places that I think good culture and acting in clients' best interest does exist is in smaller owner-manager financial advice businesses. And it's just another, we all have to embrace the spirit of regulation, but it's just another cost increase of regulation at that smaller firm level that will ultimately lead to the need for firms to scale up and either merge or sell. Because it's the very same people in those smaller businesses that are doing the trust registration, the prod, that are now going to be tasked with understanding consumer duty, making any changes to systems and processes, and implementing it. And larger firms like Adams, they'll have resources that have got people there that will do this in their sleep. And smaller firms are going to have to get the original thought out and spend a lot more time, effort, distraction, and money on it for the very businesses for who culture of trying to act in their client's best interest isn't an issue in the first place.
Mm-hmm. Okay, right, I'm going to pick up some of the comments now. I love this from Kate. She's never been more grateful that dinner parties are no longer a thing. This is from someone who welcomed the prospect of lockdown. And Simon talks about consumer duty actually being a barrier to consolidation potentially, because it sort of changes the nature of, you know, maybe why you're acquiring something in the first place and the legacy risk you've got from complaints and that kind of thing. And so my illustrious leader has asked a question, so I better ask it, that he would like to know, is it possible for high quality, properly client-focused financial planning to happen in vertically integrated firms? Discuss. I might come to Kevin on that first, because I think it sort of goes to why you maybe were a bit wary about the approaches you were getting, and that you were sort of espousing a financial planning sort of model, and it didn't seem compatible with the approaches you were getting. Is that fair to say?
Yeah, I think so. I suppose in answer to the question, is it possible? Yes, of course it's possible. But, you know, will it happen? I suppose it depends where the vertically integrating Ferriby is getting its margin from, isn't it? If it's from product, then the answer is going to be no, isn't it? It's not. It's not going to happen.
Well, I suppose I always think with like vertical integration, like, you know, there's a reason why they've structured their business model that way, and it's to get money into investment solutions, isn't it? And that's always the concern of kind of planners, especially when you've spent a lifetime building up a respected business in your local community, isn't it?
Yeah, it is. I absolutely agree. Just getting back, if I may, to the sort of consumer duty thing, and it sort of crosses over with this, and the regulator's attitude to things. I mean, is the regulator going to clamp down on deals where my payout depends massively on me shifting my clients to a new investment proposition or platform? I mean, surely they ought to be looking at that. Isn't that just one of the biggest conflicts of interest ever?
And do you hold out much hope that the regulator would get involved to that extent? Because I suppose there's a whole thing of the market needs to act. Well,
again, if we're like with, same as providers, if we look at the regulator's track record, it's a short answer, isn't it? It's a 2-letter word. No.
Okay, thank you. So what do you guys think about this idea of proper financial planning, I suppose, and vertical integration ever compatible and doable?
Yeah, I think they absolutely are, and probably more likely now. One of the reasons that we're talking about private equity money coming into the advice sector is because of how robust it's been over the last couple of years and proven its value. And I think that's created a mindset that actually you start with the financial planning and then you add the products on. And I think that's the key point to vertical integration is, well, where do you start designing products from? So codified this, but ultimately it's just good practice. I think if you make the assumption that vertical integration is about control, you end up at a bad place. I don't think it has to be. And I think vertical integration is probably the wrong phrase. I mean, we do some vertically integrated things, but it's more about vertical expansion than it is about control. What we're trying to do is fill holes that we see in the market. So a great example is we work with Vanguard, so one of the largest money managers in the world, to develop a set of model portfolios that are genuinely risk targeted, but run by the same team behind LifeStrat. And when you look at the risk-adjusted performance on that, it's now superior to LifeStrat. And the great thing is actually Vanguard are quite happy promoting that as well. And it just shows you the benefits of vertical integration. It's not a control bit; it's a pure option for our advisors to use. But I think you can look at vertical expansion as a way of doing things that cannot be done in isolation when you've got a whole of market where you can't design products and services that meet the needs of a particular financial planning process.
Mm-hmm. I know, Adam, we've been speaking a bit over the last couple of days, and I think you want to reword all my language. So I think not consolidators, not vertical integration, all of this kind of stuff. I'm going to have an alternate dictionary. But I'll come to John first, and then I'll come to you, Rob, if that's okay. John, what do you kind of make?
Yeah, I think as usual from Mark, it's a brilliant question. I think so. Our business, we recognise the benefits of scale and additional resources. So we're trying to build a national business because we feel we need access to those additional scale, resources, expertise, benefits to genuinely act in our clients' best interests. But we're determined to retain the client-focused, client-centric, acting in your client's best interest, that high bespoke service delivery that you normally would only assume could exist in a boutique firm. So I think, to Adam's point, as long as the starting point is advice, I think there's no reason why advice businesses don't participate in the fund management or the custody capability. I think the problem is there's two problems I see. One is where it starts from the product and comes the other way, because then it is shoehorning, churning, little regard, and hopefully the consumer duty legislation will impact on that. I think the other problem is, even if you genuinely start from an advice perspective, you could be seduced into trying to have fund management or platform type capability that end up causing a conflict of interest in your business. because it could drain capital out of the business that you should be spending elsewhere. It could end up in a suboptimal type of outcome. So to Mark's point, I definitely think it can. I'm nervous, and I suppose equally opportunist. There's an opportunity and weakness to it. I don't think it can be product provider led. It has to come from the advice sector if it's going to retain that client focused sincerity.
Mm-hmm. So I suppose it might be the case then that we're getting to a place where, on the one hand, you have the provider-led product stuff, and then you have the financial planning type stuff, and both firms can be big and scalable and profitable. Hopefully, it's just, I guess, it's the consumer understanding which track they're on. And
both can do a really good job for their clients.
Yeah. Rob, I know you wanted to come in, so before I bring you in, I'll just kind of acknowledge some of these comments around. I think there is this kind of thing around, client-focused financial planning versus selling investments, and the whole idea that, whether you have an advisor-led centralized investment proposition or you have a platform or provider one, with the latter, somebody's making a margin on that, so that doesn't really tend to sort of lend to good client outcomes. But Rob, what did you want to sort of say on all of that stuff?
I think that if we remember back to like the IFP and the PFS, depending on which kind of camp you're in, and I'm being reductive here, right? But depending on which kind of camp you're in would largely depend on what kind of firm you became. So if you were at Celtic Manor once a year, you were probably really into cash flow modelling. You were really thinking about intergenerational wealth transfer. You're effectively a strategist, and the product is then sort of commoditized. It's important, but it's not front and center. It's stuff in the background. If you were in the PFS, you were into acquiring exams, and you were probably a little bit more transactional. And that's certainly, I think today, I go and see lots of firms, and there's no right or wrong, but there is a difference. Everybody's saying they're financial planners, but often one person's financial planning is a bit more like a family office treatment, and another one's is much more sort of transactional, kind of one-off. So some firms will say, we do holistic financial planning. If you ask us the right questions and stick around for 10 years, each year we'll have done one bit of your portfolio and your life and everything else, and we'll sort it all out. Whereas some financial planners will say, we won't give you a scrap of advice until we know everything about you, and it's about your life and your hopes and dreams and goals. Different thing. And I think we're struggling for definitions. Part of the problem with vertical integration, it's not a problem, it's an opportunity, is that it's very scalable. Advice, not very scalable, because it's relationships and human beings. Since the pandemic, we've had some forced adoption, which I think is good because it moves markets forward when you have that. So we have this type of interaction, and all of my clients are spending a huge amount of time figuring out what that hybrid proposition looks like and figuring out how they can start to add some scale. Because what they're realizing, everyone's starting to realize now that you're in the judgment game. You're strategists. If you're financial planners, you're in the judgment game. You're accumulating knowledge, converting it to wisdom, and allowing the client to make good decisions now and into the future. And that's very hard to scale, but the technology's coming now to scale that. Everyone's business is a pipe. And, as Adam was saying, you're constantly working at trying to figure out how to streamline that pipe. It's not necessarily just about how do I clip the ticket all the way down the investment proposition. Yes, there are those opportunities. Most of the firms I work with, a significant number have gone half a yard, so they've got $1 billion of AUM. There are obvious questions about trying to take control of the platform, about trying to have your own funds, about trying to control these things. And it isn't always about money. I think that vertical integration gets a bad rep, and we're going to start to see some really powerful firms coming through that have that. And it's a bit, and yet they're not dreadful sort of awful businesses that are ripping off clients left, right, and centre. I think everyone likes the vertical integration that they like and hates everyone else's. It's a little bit like that.
Yeah. Everybody is doing things right in their own house, aren't they? So I'm going to try and slowly draw things to a close. I know we started a little bit later, so I'll just run for a few minutes longer if people are all right with that. But Matthew made a great point here, which I'll just kind of bring up, which was he's kind of following the discussion and listening to what people are having to say and stuff. And he says there are loads of advisors out there that are all high and mighty when it comes to their views on consolidating and selling out. And the reality is often very different. Support staff like me are sold. And I think, Kevin, that was kind of where you were coming from, wasn't it? In that you wanted to look after your people and you wanted to make sure that, I guess you could look them in the eye when they kind of, when you see them and stuff, isn't it? And that's probably, regardless of what's happened in the last sort of 40 minutes or so, I'm guessing that's still your view, is it?
It is, absolutely. And I think it's a great point by Matthew. And in the article I wrote, that it was support staff really that I was referring to, because I think in any deal, your advisors are probably going to be okay because they've got the relationships with the clients and with the professional connections, and therefore they're sort of paramount to securing that income stream, aren't they? But we've got 32 staff and only 6 are advisors. So yeah, my worry was, like, particularly if they closed our office down, which I think would be a real risk just because of where we are in East Yorkshire rather than in Leeds. So I would have thought, 20 odd people there, who most of whom have trained with us, products of our sort of graduate training scheme or apprenticeship schemes or whatever, I think would have been at massive risk, and I just don't think they deserve that.
Okay, yeah, thank you.
It's always one of those bits that I think does surprise me. I mean, we've done, we just announced we've just gone through 10 years of deal making, 50 acquisitions. To my knowledge, we haven't made a single redundancy as a consequence of those 50 acquisitions. Because we're a growth business, and ultimately, I think someone said earlier, financial planning is still a pretty people-intensive business. So you can make it more efficient, but we've used that to make us do more, to service more clients, to get better outcomes. I don't think any profit aggregator, any firm that's got a similar business model to us, is looking for cost synergy, because there's not huge amounts of it in there, and actually it's completely destructive because it hits your most fundamental requirement, which is client consistency.
I would go even one stage further than that, Natalie. I mean, the firms that we've bought have sold to us at a lower price than they could have got in the open market, sometimes significantly lower, because they recognise that it was important to them. They're at a stage in their life where they want to know who's going to keep their promises when they can't. And those promises are the promises that they've made to their clients and their staff. So, Matthew, honestly, there are a number of great guys out there that are paying for it where it really matters by accepting a lower purchase price for the business, because they're determined to look after their clients and their staff. That, for me, is how you identify that you've bought the right business.
Okay, thank you. Right, I'm going to try and wrap up. Caroline makes the point around, however you're kind of terming things, there's always going to be good and bad in whatever model you run and whatever you call it. So that, I think that's a fair point. But I suppose just to close then, I mean, given everything that we've talked about, I'd be interested to kind of hear what you think in terms of whether you feel like consolidation, which I'm still going to keep using that word, Adam, I'm sorry, but whether you feel that it's kind of generally net positive as things stand for clients, or what you would kind of change about the way the market is currently operating. That's quite a big question. I don't know who wants to wade in first. Rob, I'll pick on you.
Well, I have a vested interest in it keeping going, don't I?
Yeah.
I mean, partly, we do a lot of projects with firms where they're growing and everything else. Ultimately, the smartest business owner reaches financial independence through dividends. And then when they're selling their business, they don't have to make that the be-all and end-all massive financial decision at the end. So I think everybody on this call would probably agree, and we've all said it in various ways, the longer you can start, the earlier you can start this process and start thinking about what you want to do, the better, because you can put the conditions in place to make sure that when it comes to sale, you can ultimately, have a free choice of how you do that. So if you've got a shorter timeline, there are a lot of people buying firms now. If there's 30 or so fairly green private equity, operations, those businesses right now are effectively what we call SPVs in the trade, the special purpose vehicles. All they're going to do is buy things for a while. They'll be a bit like a snake swallowing a goat, and then they'll try and integrate over a period of time. I think I would have to ask why I would do a deal with someone like that over a firm that has a huge track record and has been doing that for a long time and has transformed itself into something else now. I do think we're going to see, some of the earlier consolidators being sold. Succession obviously today is a good example of that. I think there are others who are funded by private equity funds where, sure, they can do dividend recapitalization, but ultimately at some point they're going to want to come out, and the structure of the fund will necessitate that. Some of those firms will go to listings. I think the business is generally getting bigger. It's getting harder to start a small firm, and sort of, be very entrepreneurial at a very small micro level. I think that if the Consumer Duty does what everyone hopes it will do, then ultimately bigger could be a little bit better. I think that for those people that don't like that, I think they should ask themselves if they were the ones driving those slightly bigger businesses, would they have a different opinion?
Mm-hmm.
Possibly.
I think that's at the heart of it, Rob. I think bigger businesses this isn't going to be popular, but I think bigger businesses can do a better job for their clients. Unfortunately, often they just don't choose to. And therefore, you're almost faced with a compromise between the resources of a bigger business that could do a better job for their clients with the sincerity and authenticity of a small business that is determined to act in its clients' best interests. And I'll go back to what I said at the start. I think we are in a bubble for valuations. And I think there is an increasing likelihood of taxation in the future. If you're an older principal, I think you should start the journey, but I think you should surround yourself with people like Rob or other consultants, specialist lawyers, get the right advice. And I think it's crucial that you get the cultural piece right. You need to understand the motives of the buyer. You need to understand your motives as a seller. And the better alignment there is between what's going to happen to the clients, the staff, and the shareholders post-acquisition, the more likelihood it is for success. And the biggest challenge for small owner managers is if you sell, just remember, you've sold. Back to your agent and principal thing, Rob. Too many people, the integration fails because the seller has taken the money and not thought they've actually sold their business. They want to continue their life as if they hadn't sold it. And that's a challenge.
And John, that's a great point in that however you sell, whether you do a downstream model like us and integrate first or something like, you've always got to integrate. That there's always going to be some pain. We'll try and make it as smooth as possible, but there's always going to be some pain. I think that the bit to the question for me in that, yes, it can be an absolute positive because it brings capital in an efficient way. So if you're someone like Kevin that can afford to take it on the drip across a dividend, then that's great and a fantastic model. But for a lot of people, they need that capital, and the junior people in the business aren't going to be able to borrow it. And that's when firms like us provide a great service in what we can provide a home international wealth management business with that coverage and those scale benefits, but still provide that continuity. We have some wonderful conversations with principals who transacted, gone the whole way through, and now they can clear their parents' mortgage, their kids' mortgage, they can share, their brothers and sisters. And it's wonderful when you don't just see a pound sign, you see people's lives being fundamentally improved because of something that you've done to help. And a lot of those principals are still engaged with us. The one bit that we always encourage any potential seller or transaction to do is go and talk to the people that have gone through it, because we don't need to do the promotion of it. Those people will do it for us.
Okay, thank you. And Kevin, is there anything that you want to add to any of that, or kind of your pearls of wisdom on kind of weighing up some of this stuff?
Well, in terms of, I don't know if it's a pearl of wisdom, but I think John and Rob both touched upon the subject of planning ahead. And, 2 or 3 years out is not long enough, really.
Not time at all, really, is it? Yeah.
Because you're going to be 2 or 3 years on any kind of air now, aren't you? And for me, it started a long, long time ago to be able to assemble a team. And I don't just mean advisors when I say a team. We've got head of finance, head of compliance, head of business development. So we've got the resource that will allow us to still be strong and still be completely independent. I don't just mean in a regulatory sense. So you've got, if you want options, you've got to start planning well ahead. You can't just assemble a team like that in 6 months or something when you want to retire. So that would be my passing shot is plan well ahead, unless you want to be left with one option, which is just to
when you're left
sell
with
to
one
the
option,
highest bidder.
It's pretty desperate when you're left with one option that might be a bit unpalatable, isn't it? Okay, thank you very much. Thank you all to our panelists. They were brilliant, and it was a very kind of live debate, which I thought it would be. I'm sorry if I didn't get to ask your question. I've even kind of extended it to 55 minutes, and we've still probably only gone into a little bit of where this conversation could go. So thanks ever so much to everyone for taking part, for watching us. We'll be back this time next month with a different topic. But thank you very much to our panel. And I'd just like to say to Gary and to Kate and to all the advisors and planners, you are very special and you do a brilliant job. So thanks so much for joining us. I'll end on that note, and I hope to see you again soon. Thanks very much. Bye.
Thanks, everyone.
Cheers. Bye.